Hi, this is David Skarica, and this is our second in a series of videos of maximum pessimism investing. This one we're going to do a little take, in that where I'm a little different from John Templeton, is that I also incorporate technical analysis to help confirm my fundamental shift and my fundamental belief that markets will move higher and the whatnot, or a stock or a market will move higher. And what I do is, there was a guy named Nicholas Dargis who wrote a book, How I Made $2 Million in the Stock Market, back in the 50s. And what he incorporated was a box theory, that stocks essentially create trading ranges and then start to range in a box. And I just, quote unquote, trapped in a box. And essentially what we got to look for is long-term bases or boxes after the sectors have been hit. So Dargis is looking more short-term, and for stocks to they break in a box for 2 weeks, then break out and then move higher and that sort of thing. What I like to do is look for stocks that are basing after these boxes after the sectors have been hit. So I like to see the stocks that we talked about last time in our presentation, that stocks would have fallen 80 or 90%, and then maybe build a base over 6 months, 12 months, 18 months. And that's where you have to be patient. This could take months or even years to form these bottoms. But we've had some big gainers in my newsletter using this theory of box investing. And let me give you some examples. I don't want to give away these stocks right now because these are for paying subscribers, but this is a company that basically formed a box between $1 and $2 a share. And we started buying here thinking it would break out. And recently it went high over $3. It's trading in the mid $2 area right now. We're up about 50 or 60% of this in a few months. I really got into this over the summer. So you can see you had to wait for this company to form this box of bottoming over about a 2-year period. But once it broke out, you had some big gains here. This is another company that we waited for the same thing. I waited for the box to build between about $1 and $1.70 a share. We got in near the bottoms. I thought it was basing. This is a very undervalued company as well. So I incorporate the boxing and bottoming with the fundamental valuations and with the fact that I think there's going to be a big macro turnaround in the play. So we got in here around $1 a share. This spiked about here. It's currently trading around $2. And again, this is the kind of thing we do in the newsletter and the kind of deals that we've been looking at. I got many more stocks like this. I'm going to give you some examples in my next presentation next week about stocks and how I go about picking them. This is another example of a company, a market that did a big box bottoming. After the home building stocks collapsed, about 90% from their high, they based for actually nearly 3 years. And then when they broke out of this box of about 150 to about roughly 300 on the Dow Jones U.S. Home Building Index, you can see we went actually over 550. So again, if you had noticed this box building, realize, hey, this is down 90%. There's not much downside in this. Probably could have gone in an average price of about 200. And just as of earlier this year, most home building stocks almost tripled from the bottoms. This is another stock that was probably one of our big gainers of the last few years. This is Tata Motors. And I didn't even know I was using the box theory at the time. I was just looking at an undervalued company. But we can see a box bottoming formation formed after the 2008 financial crisis. And Tata bottomed between roughly $3 and $5 a share. And when it broke out of the box, it went all the way to 36. So this is an example of the kind of big gains you can get after these collapses and waiting for a box and bottoming formation to build. I've been bullish on Europe for a while. And again, another box bottoming formation has been in Italy. And we can see this box bottoming formation going sideways, and then now we've just broken out. Now we're a little overextended in the short term, and I'm looking for a pullback. But then I think because, again, Italy built a 2-year base, we can move out of this. And I've got actually an Italian company trading at 1/6 of revenues right now. And I will talk about that. I'm going to give you the name for it, but we'll talk about that next week. And I can show you that this company's building a box, smaller cap play, so maybe a little later in turning around. But I think it's a great way to play the Italian turnaround. So I think we need a consolidation in the Italian markets and the European markets. This is another example here of a box bottom formation. This is Spain. We can see 2012, a bottom built between $20 and $24 a share. We broke out. And then we can see another box forming here. And then again, Italy broke out. So Spain broke out here. So again, look, we're actually near 2-year high in Spain in the iShares, despite all the negativity on Spain. because of the debt crisis and whatnot. So I think, again, we need to pull back for the next move higher. But I think where you're going to make it, and the one company actually had, the one I told you was in a dollar, is actually a large Spanish company. And again, I think there's a few Spanish plays that we can take care of in kind of the middle end to small cap end that will take advantage of this of the next rally in Spain. And what we can see is that, again, taking advantage of max pessimism, in Spain you could got his iShares at $20, $22 a share. You're up 80% right now. The Dow has not gone 80% since 2012 lows. So it just shows you, again, mixing up boxing, bottoming formation with a maximum pessimism trade, and buying undervalued assets, how you kind of make money. Another stock that we've been long, still are, is IRE, Ireland Governor Bank Company. Again, note that I was a little early in this one, started buying here back at $10 a share in 2011, but then waited for the box to form after that, averaged down in here, and now the stock is probably more than double our price. So this is the kind of thing you have to wait for and whatnot. So, using maximum pessimism, we look for out of favor assets and sectors that have fallen more than 80%. Usually the news and sentiment is terrible and negative, and then we look for markets and sectors that are showing signs of breaking out and boxes moving higher.
Final presentation, we're going to talk about using maximum pessimism to pick stocks. Now, I've talked about in these previous presentations what criteria we look for. We're looking for stocks or industries or markets that have fallen usually 80% or more. Sometimes you can look for something that's fallen as little as 60 or 7% or as much as 90 to 95%, but usually roughly 80% or more. We showed you the type of returns you get after a market drops 80 or even 90%. Then we're looking for an industry that can turn itself around. Investing in horse carriages in 1910 wasn't a good idea, even though the prices were probably coming down pretty heavily at that time. So that's another thing we're looking at, something like housing is cyclical, always come back, in some degree or form. You look at stuff like the collapse recently, like solar or wind. These are industries that are going to still be here and going forward. So we look for an industry that can kind of turn itself around. Maybe a new product for a certain company, like Apple languished for years and years and years, and then when they came up with iPhones and iPods and iTunes and these type of things, and got more into hardware again, especially with the iPods. That kind of helped turn the company around. Then we look for maybe a cheap valuation, a low PDE or discount to revenues. A lot of companies which get depressed and haven't grown for a while, they start trading at 1/5 of revenues or 1/6 of revenues. Then sometimes the company can be highly indebted, and that's actually a good thing, because sometimes the best returns are in actually these companies that people think are highly indebted and think that they're going to turn around, or not turn around, and that they're going to go bankrupt. And then in collapse markets, we look for stable industries. We look for, in the markets themselves, like a lot of times you're looking for telecoms or grocery stores or things that people are going to have to use even in a depressed economy. So the perfect example of one of our maximum pessimism plays is a few years I bought Tata Motors. And Tata Motors is an Indian car maker, and we actually bought a 350 right here. And you can see, first of all, the box, it based between $5 and $3. You can see the breakout, and then Tata had everything going to it. It had a new product coming up, had the Nano, which was the cheapest car in the world at the time. That actually didn't even really sell that well. What turned it around is that the company took over Land Rover and Jaguar, and that turned it around. And ironically, they had to take on a lot of debt, so people that worried were Tata was going to go under. But I figured if the U.S. was going to, bail out its cars industry, Tata or India it's too. So that's why we got into this, and this ended up being one of our best performers. We actually still own it till right now. So that's the kind of example of the maximum pessimism play, where there's a company that can turn around. Let's face it, there's going to be a lot of cars sold in India as well in the next 30 or 40 years. So and I figured that buying Tata in 2009 was like buying GM back in 1920. So a lot of cars are going to be sold in the States, an industry that can turn around, new products with the Land Rover, Jaguar, and the Nano car. And that's kind of an example of what I do. And because Tata had to take on a lot of debt, people thought they might fail. Atlantic Telecom. Telecoms are interesting companies for two reasons. Number one, they always have a lot of debt because they have a lot of overhead and infrastructure expenses, etc. They got to set up cell phone lines, whatever. But they're also something people need. People are going to use their phones even in an economic downturn. So they always tend to be leveraged plays when you have like a debt crisis. Because the reason is people are worried that they're going to have to finance their debt at higher levels and they won't be able to afford that debt. So Atlantic Telecom, we started looking at my newsletter when I was getting bullish on Greece. At about $1.40 a share, we were actually in last August. We missed the exact bottom and still got in pretty good. And we just figured that this stock was very cheap at the time. Deutsche Telekom has a big position in it, so I figured that it did get into debt problems. Deutsche Telekom would really help out, etc. Another example, and I didn't buy this stock, but is Teal. Teal, first of all, had the box base. What happened here in 2002, collapsed during the Argentine debt crisis. Again, people were worried that a highly indebted telecom company wouldn't have access to capital, or renewing their rates would be so high the company would go under. And then when Argentina turned around, we could see the TO went from 50 cents to $24 in a 5-year period. And after actually a year and a half after bottoming, was already back at $10. So these are the type of returns you can get. Again, stable industries and kind of a maximum pessimism collapse thing. So this is a couple stocks we're looking at now. Now I've hidden the stocks because they're for paying members, which we're going to tell you about in a second. This company here has collapsed. This company actually came public at $14 in 2011, went to $1. It's in the alternative energy arena. Is now based between $1 and $2. Just broke out of its box, rallied to $3.50. Now it's consolidating in the mid $2 area. And I think that this is going to be a big player in the alternative energy arena and do really, really well going forward. And this is the kind of bottoming, collapsing stock. Now we're into this, my newsletter, roughly about $1.70. This is another company. This is actually the company in Europe. It's trading at 1/6 its revenues right now. It's actually gone down 90% in the last 12 or 13 years. They're finally doing a major restructuring, and it's in a stable industry, and I think it's about to turn around. But again, these are the kind of ideas we give in our newsletter. So one of these companies actually is based in Asia, and the other one in Europe. We think they're excellent turnaround plays and maximum pessimism plays at their current levels. This is another company. This is a company that's in the resource arena. They have a major deposit in Eastern Europe, and this deposit is supposed to go into production in 2015. They've already got access to financing. We think that this is going to do very, very well going forward. So these are, again, the kind of things that we look at here. And the stock